My share price is higher, though. I've got a lot more future earnings potential.
Yeah. God, I'm really worried about losing money. I'm not going to buy any financial assets.
The whole of Scotland just switched off.
Joking. I was having a bit of fun with you.
So you're getting a yellow card straight away. Now, talk about not getting markets right.
Why are you looking at me? Why are you looking at me?
I'm glad he looked to you, not me.
Wow.
Your capital is at risk. The value of your shares, ETFs and ETCs can fall as well as rise, which could mean getting back less than you originally put in. This content is for information purposes only and is not investment advice. Past performance is not an indication of future results. Welcome back to The Art of Investing, a new podcast all about helping you achieve your investing goals. Brought to you by IG, the global investing platform, a FTSE 250 company with over 50 years in the markets and here to champion the investor. If you're new to investing or you've been doing it for some time already, you're in the right place. I'm Rich McDonald, and every Friday I'll be joined by my co-hosts Mark Spice Holden and Chris CJ Fellingham to turn market chaos into investing clarity. So first of all, I'm going to go to Spice. Please introduce CJ.
Well, that makes a change because he's more senior than I am. So normally I'm coming on second. But joking aside, he's way too modest to ever say much about himself. But he is one of the best all-round investors I've ever worked with. And so that's enough of blowing smoke his way. But he's also a world leader in government bonds. He instinctively understands risk, which is a really key part of running any sort of portfolio. And he's worked at the highest level in some of the biggest and best investment firms around the world. The fact that he's always been more senior to me probably explains why he looks more stressed than I do.
Very good.
And certainly why he has less hair than I do.
Over to you. Tough to beat.
Gosh, how on earth does one follow that? I mean, what a great write-up. I wish I had such great things to say, but unfortunately, I've got to be realistic. No, on the real side, Mark and I have known each other for about 40 years. Mark's worked on both sides of the fence. He's worked on the buy side and the sell side. And the great thing about Mark is Mark tells a great story. And therefore, he can do both extremely well, as we will find from this podcast. He's a trend follower. He's a momentum investor. He likes the markets when they're moving in a way with an impulse. He likes to get on that and follow that. But he's very good at getting off quickly when the market turns around. He loves rugby, equities, and commodities.
Now, as you can already tell, these two can talk. And nowadays, Gen Z attention spans are about as short as you two's memories will be in a few years' time. So to combat that, we have a yellow card, which we have yet to get quite to the bottom of what the punishment will be. So I want to hear from you, the listeners. What should the punishment be for a red card? If these two ramble on too much, write to us, theartofinvesting@ig.com. It's a reminder why this podcast is different from all the others. We're going to be launching a model portfolio, which you can follow at home. And you're going to find out that these guys, the Warren Buffett and the George Soros of the UK, how they construct that portfolio and then how they manage it over time. So today we're going to be talking about what do you have to think about beforehand when constructing that kind of portfolio. And then over the coming weeks, we're going to take a deep dive into the asset classes. And today, Spice is going to bring you equities. So without further ado, it has been quite the week. Mark, what's been happening?
Well, as you say, it's been a pretty hectic week. Underlying that is because if you look at the top level, actually markets haven't changed a great deal this week. We're sort of bumping just below all-time highs, which is great. There's consolidation at these higher levels, which is good. But we are just starting the second quarter or interim reporting season, which for equity investors is very, very important. And it really started with a vengeance this week. It picks up in the next couple of weeks. So this week we've had big results from companies like ASML, which is the company that makes machines, that make chips, that goes into the AI boom that we're all hearing about. But they had a bit of a profit warning. Their shares were down about 9% yesterday. And Renault had a similar sort of bad day where they were down about 15%.
That's the French car maker.
Exactly. And, both of them pointed to the fact that they're uncertain about what's going to happen in next year in 2026. And so analysts being analysts sort of take that as meaning if they're uncertain, just to nudge the numbers down a bit. And that's in fact what the management want to do as well. They want to get the numbers down a bit and then hopefully beat it later. And you'll find that happens with equity guys.
But isn't that the same as always? I mean, I'm, as you know, a bond guy, so I don't know a lot about equities. But whenever I look at equities, I see that the management talk down expectations one week, beat it marginally the next week, and the same story goes on the whole time and the stock market goes up. So isn't this just normal preparation?
Oh, totally. It is a art. This is one of the arty bits of sort of investing. And I was going to talk about it in equities anyway, but management, the good management teams will make sure that they can always beat analysts' expectations. In the run up to them actually announcing it, they've normally noted their numbers down, sometimes by 4 or 5%. So they actually, on the day they report them, beat them.
And of course, who's going to be better than that than investment banks? So funnily enough, JP Morgan managed to beat numbers. Bank of America managed to beat numbers because they manage expectations very well. It's a little bit, like when I go out on a date. I don't want to build myself up to be more special than I am. And companies do the same, don't they? They set a level of what their expected profits are going to be, but still with the thought in mind that they'll be able to beat it on the day.
Absolutely. And the interesting thing, as you mentioned, the banks, they've had a great year so far, mainly because Trump is bringing in deregulation of some of the financial markets, allowing them to have more capital that they can use to grow their business, give back to shareholders, what they would choose to do. So pretty much all the banks we've had report so far this week, Citibank, Bank of America, as you say, Goldman Sachs, Morgan Stanley, all beat expectations. Interestingly, the shares moved very little, actually.
CJ, what has been happening in the bond market then? Because you've seen a move at the long end. Now, you introduced us to what the long end is last week, but what has happened with this Jerome Powell story?
I think there's two stories this week. First one was CPI numbers coming. So that's inflation. So when we look at inflation in financial markets, it's called CPI, consumer price inflation. And inflation numbers generally have come in, on the high side, either at expectations or above expectations, if we talk about the UK and in the US. So that's made people think about, well, maybe interest rates aren't going to be cut as quickly as they would otherwise be. That's led to, certainly in the UK, 30-year bond yields back up towards 5.5% again. At the end of the day, though, in the States, we're back up at 5% at 30 years. And we're at that sort of, are they going to rise a lot from here or not? Are they going to hold here? If they hold here, equities are fine. But if they start to rise from here, they might undermine equities. Now, to your point, out of course comes Trump yesterday with one of his classic Trump moments. Has an interview. He says, well, I've seen the document getting rid of Jerome Powell, the chairman of the Federal Reserve. Clearly, an extremely important person as far as the US monetary policy is concerned. Markets suddenly turn tail, run down, equities fall 0.5% to 1%. Uncertainty everywhere, dollar sells off. And then he comes out and he says, well, effectively, he says, joking, I was having a bit of fun with you, and back it goes. So net, nothing happened in that sense, but it just shows that the political risk in the States continues to be high when the person in charge feels that markets are there to have a bit of fun.
And we're going to talk about risk in a lot more detail in a few minutes' time. But I thought this problem of inflation, I thought that was a post-pandemic thing. 2022 inflation, we all know what happened. I thought it was gone. I thought it was solved.
Well, it had been trending back towards the level central banks want it to be, which is about 2%. But, the Europeans want it at 2%, we want it at 2%, the Americans want it at 2%. And we're trading back to that. So the UK is coming in at about 3.6. So the CPI data, the inflation data should look a little bit better. But mixed into all of that is what's happening with tariffs. And we don't really know still what impact that's going to have and how many companies are going to put those tariff increases through in terms of prices that go through to the consumer. That will be key. That will be what drives the next wave of the CPI inflation data and ultimately interest rates.
But there's worries around the central bank. There's worries around inflation. There's worries around the Middle East.
Return back to what we said last week. Bull equity markets climb the wall of worry. So while there's things to worry about, there's people sitting on the sidelines with cash, wondering whether they should be investing it. So the markets continue to remain bid and push upwards. The time to worry is when there's nothing really to worry about and everybody thinks things are relaxed.
Euphoria.
And that's when you have to be careful. But we're not there yet. We're going to be obviously talking more about those subjects in the next few weeks. But at the moment, there's still room to the upside. There's one asset class which we haven't spoken about yet, which I think is going to be important for us for our portfolio construction, which is, and I'm not sure whether I dare say it, but cryptocurrencies and Bitcoin. Last week, Bitcoin had a tremendous run. Actually, Ethereum, which is another cryptocurrency, perhaps the second most famous one, did even better. It was up about 30% last week against Bitcoin up about 8 or 9%. The reason is that this week is called Crypto Week in the States, where there are three acts going before or three bills rather, going before the Congress. And they're all supportive of the crypto markets. And so people have thought, well, this is coming through. It's not just theory, it's going to happen. They're going to become an investable asset class. People are getting more and more excited about it. The bulls are back in, the hype is starting. And some of these things are doing very well indeed at the moment. So we'll be tackling that 2 or 3 episodes more in. We'll be talking about cryptocurrency where maybe that should appear in your portfolio construction. But it's important to see how well they've done.
You two you're both very bullish on every asset class. So you're getting a yellow card straight away because we are meant to be down the middle. We're meant to be open-minded. And all I'm hearing is new highs, supportive to assets. What about good old-fashioned cash?
But you're not listening carefully enough because actually, when we get to bonds, which will be next week, we're both probably pretty bearish of bonds because we think bond yields have to go higher with the way that governments are borrowing more money. I'll be explaining all this, how it works next week. But if you remember from our first episode, government bonds is the difference between how much a government buys and how much it sells is what they raise in the bond market. And we just think governments are going to spend lots and lots and lots of money and they're not getting so much money in, and therefore there'll be a rubber meeting the road moment.
Interestingly, NVIDIA, the world's biggest company, hit a market capitalization of $4 trillion, which is the first time any company's ever done that last week. And to give you some perspective again on NVIDIA, this is the world's leading AI chip maker. Mm-hmm. And it wasn't that long ago that people were worried that they were never going to be able to sell any chips to China. This week, guess what? Trump and co turn around and say, actually, you can sell your H2O chip to China again. The share price popped up another, popped up another sort of 7 or 8%, and is now up 100% from where it was on April the 7th, when it had just fallen 30% after the Liberation Day sort of
3 months,
speeches.
It's doubled.
It's doubled, and it's the world's biggest company.
And when we talk about it doubling, it's added $2 trillion of market cap. Give us an idea. Nobody knows what a trillion is, right? It's, a hundredth of a quadrillion. Put that into perspective with a UK stock market or a European stock market. What is $4 trillion of market cap?
Okay, so to give you that perspective, the UK's biggest company is AstraZeneca, and they are $0.22 trillion of market capitalization. So NVIDIA is 18, 19 times bigger, okay, on its own. And to give you even more eye-watering facts, what is really scary is that NVIDIA on its own is 30% bigger than the entire UK stock market put together.
30% bigger.
One company, and it's 30% bigger. If you're a professional investor, if you don't get NVIDIA right, you ain't going to get the markets right.
Now, talk about not getting markets right. There is... no, not that. That wasn't my intro.
Why are you looking at me? Why are you looking at me?
I'm glad he looked to you, not me.
Wow.
So it's so important to emphasize here. We're talking about long-term investing, right? We're not talking about trading. We're talking about setting up a portfolio that is going to perform over the long term, over a number of years. And you've given the number of 10%, right? That's going to be the sort of benchmark that we're looking for. Now, anybody can say, I've made 10% in a week in Bitcoin. But we're talking about pensions, about ISAs, and what considerations do you have to take in when over the next few weeks, we look to construct that portfolio and then launch it.
Some great commentary and comments there, Richard. At the end of the day, portfolio construction isn't about just buying one company, holding it and going, look how brilliantly I've done, except if it goes badly, when look how badly I've done. Portfolio construction is much more of a difficult science. And there's many things to think about with portfolio construction. And as you say, our intention is in a couple of weeks' time to form our portfolio, having talked about the asset classes, and then people will see how we think about some of these things and put it all together. But what I wanted to talk about today in particular is risk and how people think about risk. There are many, many, many different ways of thinking about risk, but they really drop into two categories. The first category is loss aversion. The big sigh from you there, Rich. So obviously, this is one that's got a lot of sympathy with you.
The whole of Scotland just switched off.
Yeah. It's really interesting how we as society have made this the big definition of risk. What do I mean by that? If I go to see a wealth manager, one of the things they ask, how would you react if the market fell 20% over the next 3 months? And they're always negative. And they're trying to gauge what your risk appetite is. Okay. They are doing that to protect themselves from the regulator who is saying, you must know your clients before you can do anything for them. And the way they do that is by understanding what your attitude to losing money is. And that's what they're defining as risk.
And I guess this is what Rachel Reeves was touching on this week, is that the regulations around wealth managers, around banks, we've built it up so much over the last 15 years that it's now holding people back from taking risks.
Well, as I said earlier, she'd obviously listened to our podcast last week and finally decided to follow the trend here. And that is, she's saying we are too risk averse and therefore we need to think about it in another way. Now, the way I like to think about risk, so that's one way of thinking about it. The way I like to think about risk is your risk against your liabilities in the future.
Like Spice's boat and there's the big holidays.
So Spice says, I want a big boat and I want a great holiday. How am I going to get there? He therefore has a plan of what he needs to get in terms of returns to get there. So we need to think about risk in terms of against that liability. So against what we're hoping and aspire to in the future, what's the biggest risk you can take?
Well, that's a complete different concept. I've never looked at that. So when I get to your guys' age, then I already have to know what my living expenses will be roughly.
You've got to think about what you would need and how are you going to get from this size to that size. So the biggest risk, you very cleverly changed the topic there when I asked what the biggest risk is. The biggest risk is cash. Because we proved in last week's episode that when you look at returns on cash after inflation, it's negative. Bond markets, equity markets, over the long term, after inflation, give you positive returns. So if you sit there holding a lot of cash, you're actually losing purchasing power for the money in the future that you're going to have. So the first thing to remember from the way I look at it, therefore, in this basis is, whilst cash might be something you want 6 months cash to make sure you can pay your bills or whatever, when you're looking at your investment portfolio, what you need to think of is, what financial assets do I need to be in? Because we know those financial assets will, over the long term, beat cash.
The only time cash works properly as an investment that actually makes you good relative money is when you've got deflation, not inflation. And that actually is something that all central banks fear and will do everything they can to avoid, as we saw during the credit crunch, the great financial crisis. When prices start going down, the only safe place to be is something either like gold, but more importantly, cash.
Right.
Because it can't fall in value. It may not go up in value, but it can't fall in value. And when interest rates, as they did during the financial crisis, go negative, and you have to start paying the Bundesbank or the German banks, the central bank, to hold your cash for you, why would you do it? It's madness. Yeah. But if you think and historically we've only had very few bouts of deflation, so there's been very little need to have cash. Over the longer term, inflation has averaged 3%. Mm-hmm. And if you own cash, you will make no money on that. It's a zero-sum game effectively against cash.
Because that's about the average interest rate as well.
Exactly.
So you get nothing. The other end of the argument, I'm worried about US stock markets at the moment. I think that they are potentially fully valued I think a lot of people, when they hear the word portfolio, that means 8 stocks or, 12 stocks or a few ETFs. You're not saying that you've got to be fully invested into stocks, individual names or whatever. There are a number of assets that are available with varying levels of risk.
So that's why I attempted to choose my words carefully and talk about financial assets. So there are lots of different financial assets, ranging from government bonds, corporate bonds, private equity, public equity, commodities, cryptocurrency. All these things are all asset categories.
But is there a podcast where I can find out about each individual asset class?
There, funnily enough, happens to be one that is just started last week, and we are intending over the next few weeks to cover each of these asset categories for the following reason. If you accept my argument that cash is a highly risky strategy against your expectations for the future, your liabilities in the future, and you want a financial asset portfolio, what it makes sense to do is to build a financial asset portfolio of, and I'm going to put it in inverted commas, cheap assets. You will hold those assets, and over time, some will go expensive. And when they go expensive, you then say, I'll take some out of that bit of the pot and put them in something that's cheap, on the basis that financial assets over time will beat cash and give you that good return. So what we want to do over the next few weeks is to talk about the asset classes, talk about whether we think they're cheap or expensive, which comes to your point about what you think about the US equity market.
And also the two of you have slightly different preferences there.
We have. I am much more of a fan of the European equity markets. They're not nearly so expensive as a rule. Mark is much more of a fan of the US market and the exceptionalism. And there's a lot of good reasons to have that. But we will be talking later about how you look at equities, and then we can decide what's expensive and what's not when it comes to our portfolio construction meetings in a couple of weeks' time.
And the great thing, we are going to be having the live debates on here, whether to move some of our assets from US markets into the FTSE, whether to move some from the FTSE into gold, whether to have a bit of oil. We're going to cover everything, and we are not going to agree at all times.
No,
and bonds and cash. The cash will have a place if we think things are expensive. But you just need to remember, if you hold cash for a long time, chances are markets are going to go up, and that's cost you money. And that's the big problem for people. Almost everybody holds too much cash, and therefore they miss out on these excellent returns in other asset categories.
I'd like to take a moment to make you aware of an awesome offer IG is currently running. Until the 15th of August, IG is giving away a free UK share bundle to all new customers worth up to £100 when you invest just £20. Sign up for a general investment account, a stocks and shares ISA, or a SIPP and make your £20 investment to get started. Your capital is at risk. The value of your shares, ETFs, and ETCs can fall as well as rise, which could mean getting back less than you put in. New customers only. Offer is valid until the 15th of August for ISA, GIA, and SIPP accounts. Other fees may apply, and T&Cs apply. Mark, equities have been a big part of your life. They've been a big part of my life. I am obsessed with markets and so passionate about the asset class. There's a new story every single day. Strip stocks and shares back for us, and what are they?
Okay, let's go right back to basics. When you buy a share in a company, let's say they have 100 shares for a whole company, you'll own 1% of the company. So you're effectively owning an equity or a stock or a share is basically part ownership of a company. That entitles you to certain things. It gives you the right to have some of their retained profits if the company was ever wound up. That's the profits they built over the years and years. And if they pay a dividend, and not all companies do that, you will get a share of their dividends as well, which they pay out. It's a bit like interest on a building society account or whatever. And companies mainly in the UK, tend to pay dividends much more so than the US. But nevertheless, it's something that you'll return in both ways. Either the profits grow and or the dividends grow with this as well, and you get the returns from both.
So just to underline that, a dividend is a share of the company's profits that you're paid out, whether it's 6 months or every 12 months, and it's in the form of a percentage, just like an interest rate is.
Yes, well, it would be a sort of pence per share if you're in the UK. So let's say they've got a £1 share price, they want to pay a 5 pence dividend per share.
Mm-hmm.
So that's equivalent to 5% over the year. And you'd get that. And you can do with that 5 pence, whatever you want to do with it. You can reinvest it back in the company.
Mm-hmm.
And there are some schemes that let you do that tax efficiently. Or you can take it down the pub and spend it if you want. It's a great thing to do, but it gives you the responsibility of what to do with that cash. And the management are effectively saying, here's a bonus, we're doing quite well. And that's it. They don't always do that. Sometimes they'll ask for some cash back, if they're having tough times. And that's one of the things about equities. It works both ways. And American companies are much better at saying, well, actually, we're going to try and invest all the money we make back into the business if we think the business is good, to grow the business faster and faster and faster. If you look at Amazon, for example, over, sort of 20 years, they didn't make any money at all. And then suddenly they started making money. And for those 20 years, all they did was reinvest every penny they got, every spare pound and dollar they got back in the business, getting same-day delivery, et cetera, becoming the most efficient retailer in the world.
Right. So the company can choose to reinvest their profits in their own growth, or they give you the money and give you the decision whether to reinvest it in their shares or to take the money and run.
Absolutely. And in America, there is much more of a trend from management there to use that spare cash either to reinvest in the business or to buy their own shares if they think their own shares are still cheap. So companies like Nvidia, Apple, Microsoft, they're all buying back their shares very steadily all the time. So actually, unlike something like cash, where the cash is growing all the time because you get your salary and everything else, you get your dividends and you can spend that. The number of shares in issue are generally shrinking in all the major stock markets. So it goes back to the supply and demand again. There's actually a very gently shrinking of supply of equities going on in most of the major markets, particularly in the US, to the tune of 2 or 3% of the whole entire market is shrinking each year. And yet demand, because people are becoming more wealthy, businesses being more successful, the demand is actually going up, which is why, over time, arguably, equities should go up.
And does it matter how many shares are in the company? For example, if Chris and I had our own companies and I've got 2 million shares and Chris has got 100 million shares in him, does that matter? Why would we have different numbers?
Well, he'd be my mate, obviously. Well, this comes
my share price is higher, though.
Yeah.
I've got a lot more future earnings potential.
Yeah.
Well, I think like all these things, it doesn't matter about the number of shares you have, because he might have 100 million shares that are worth 0.1 pence each, and you might have 2 million shares that are worth £200 each.
Right.
Who's going to be better off? I think, you might be. But it comes down to one of the rights you have actually as a shareholder, owning this equity, is that you can vote.
A share is a share of the company. You have voting rights in the company, and you may well have rights to income called a dividend. And one of the great things about a dividend in a good company is it goes up each year. So it's not like a fixed amount every year. It goes up every year. So it's more and more valuable. Or they may not pay a dividend and they may buy the shares back.
Absolutely. Well, for example, the whole of the FTSE 100 on average yields 3.5%. So at the moment. So what would you get in a building society or a bank at the moment? You'd struggle to get that now as interest rates are coming down. You'd really, and particularly, particularly at the moment as interest rates are falling. But that 3.5% is also growing each year because the companies tend to try and push their dividends up by a little bit more than inflation each year. And that keeps investors happy. Americans have a different attitude to these things.
Most people at home are not going to be too bothered about the voting rights. You don't have to vote, right? You can just enjoy the dividends. But what about if a company doesn't pay any dividend and you want to buy a share that is going to see this incredible share price appreciation?
Well, the things you need to consider when you're looking at equities is the total return you're going to get. That comes from the dividend, as we were talking about, if they pay one, or it comes back to whether the company is growing by more than expected. If you think a company is growing by more than the rest of the stock market, or more than the analysts are saying, or more than your friends think, then you should probably go and buy a few shares. Because if they do that and they deliver, then the share price should go up. And the capital gain in that share price is far more powerful, in my opinion, than a dividend, which might give you, 5%. Now, the companies that give you a 5% dividend tend to be very low growth businesses. They might generate lots of cash, but they're not growing very strongly. The companies that pay virtually no dividend or very little dividend are ones who are growing. And as I mentioned, Amazon never paid any dividend. They didn't make any profits because every bit of spare cash they had, they reinvested back in the business. And if the business was at that point was doubling every couple of years, that's what you want them to do, because that will get them up and that will get the share price up. And that's what ultimately you're trying to get.
Right. Talk to us about expectations then, because Mark managed to mention there that you can't just say, oh, this is a great company, I like it, like it's a football team or something. There's a level of expectations of a company's profits and the profit growth. But sometimes it's already priced in. What does that mean?
What it means to say it's been priced in is that the management or the analyst community have already realized that company is going to grow its earnings by 20%. And therefore, when it announces its earnings have grown by 19%, everybody starts to go, shock, what's happening? It's gone down. I have this conversation all the time with my mother-in-law. Sorry, mother-in-law. But, she'll say, these results came out and the thing's down by 10%. And so what you said, the answer to that is the market was expecting better earnings than that. And although it made more money than it made the year before, maybe, it didn't meet those expectations. So quite a lot of the job of the finance director or the CEO of these businesses is to go around talking to investors and the community to make sure they put an idea in the heads of them of what they're going to make. Mark talked about it earlier, where there's a whisper number usually. So you'll find that there's an expectation from all the brokers that this company's going to earn 14 pence per share, but the whisper number is going to come in at 15.
Right.
And it comes in at 16 and everybody goes, oh, isn't it brilliant? It's beaten everything. Up goes the stock market. The directors say, aren't I brilliant? And everyone says it's fantastic. But of course, if it came in at 12 pence, the market would go down 2 or 3%. So it's all about expectation. And one of the things we will be talking about when we get to the portfolio construction phase is, what is the market expecting in terms of earnings? Do we think that's an aggressive forecast? Do we think that's a likely forecast? Or do we think that might disappoint? And I suspect that when we talk about the US market and we hear your very negative views, which I'm sure you'll be coming up with, Mark's very positive views, we'll be really talking about what's in the market. It's not that these companies aren't doing well.
Yeah.
It's what's already priced into these prices.
There is a price for growth, and that can vary. So I'm going to give you a couple of examples here. Over the last 5 years, Tesco's has grown its revenue every year by 4.3% over the last 5 years. Now, it's pretty rubbish, isn't it, really?
Yeah, it sounds rubbish. Is it rubbish?
It's
well,
cash.
it's basically because interest rates have been that high.
Yeah.
So they might as well just take the whole business, turn it into cash and put it into building society account. For the next 3 years, they're expected to only grow at 2.4%. I was looking up these numbers yesterday. And yet they're valued at slightly higher than the whole of the UK FTSE 100. So they're valued at about 15.5 times PE ratio. And they're just growing at a very pedestrian pace. But they're paying you a 5% dividend.
Mark, you've introduced something there. You've just said PE ratio.
Yes.
Could you just very quickly define that for a number of our listeners who probably aren't aware of what that actually means?
That was a subject at school that I, was particularly interested in. Is that what PE is?
Well, not on my Borstal, it wasn't. But anyway, so it's price, that's the P, and the E is the earnings. And the earnings is the amount of profits left after you paid all the important stuff, like paying your interest charge, paying your tax, etc. So it's the net bit of profit that's left. And then you divide that E by the number of shares, and that's earnings per share, the price divided by the earnings per share, and that gives you a number. And then if you did that for all the 100 companies in the FTSE 100, you get about 15 times PE multiple, a price earnings multiple. And the FTSE 100 yields about 3.5%. And so Tesco's, they trade at slightly higher PE, price earnings ratio, to the FTSE 100, but their dividend yield is 5%. So it is actually quite a lot more than the yield on the FTSE 100. So there's a group of investors who say, I don't mind the low growth because I'm just going to take 5% a year in dividend.
And it's safe.
And it's safe. It's considered safe. What it is very recession proof, because when consumers pull back, yes, they stop buying sort of supercomputers and yachts and fast cars like you'd have, Rich. And instead they buy, they've got to buy food, they've got to have bread and milk and etc. And they get the basics. And they'll go to places like Tesco's. Right. They may trade down from places like M&S or Sainsbury's or Waitrose and go to Tesco's, Aldi, Lidl, Asda.
So really safe. But give us an example of what's the opposite then of a safe Tesco value?
Well, I mean,
there aren't many in the UK. That's the problem.
I'm going to use NVIDIA, right? NVIDIA, the world's biggest company. Why not, right? So over the last 5 years, it's grown every year by average 60%.
It's earnings. It's earnings.
It's earnings. 60% a year, right? So it's doubled and doubled and doubled again. This year, it's expected to go up another sort of 50, 60%.
Wow. So that's in the price.
That's supposedly in the price. And for the next 3 years, on average, that growth is expected to tail off. The analysts are saying, well, you have to do 50% this year, then you'll do 30, then you'll do 10. And it'll normalize in theory as people buy enough AI chips, etc. So when you buy NVIDIA today, you're paying what's called 80 times the price earnings ratio. Now 80. So that is basically saying, I won't get my money back if I kept it and got my earnings per share each year for 80 years. Whereas with Tesco's, I'll get money back in 15 and a half years.
If profits stayed at the same level as they are today. And that's the key. Because you're getting that 60% growth, then the share price grows into, or the earnings grow into the share price, So
absolutely. So if you look forward 2 years, NVIDIA's shares are only trading on about 30 times price earnings ratio, because you've got such strong growth coming through. Now, it yields nothing. It's 0.7%, 0.07. It's just nothing. It's irrelevant. But if you think, and going back to expectation management, if you think they're actually going to double their profits again, then actually that they're probably trading nearer to sort of 25 times P/E ratio. Okay. So you might buy it and you'd still get another 30% potentially on the share price.
So to summarize, I think what it sounds like you're telling us is it's not just about this year's profits you have to look at. It is the earnings growth over the next few years. Is a company in an industry that is going to get bigger and bigger? Or is it, maybe you'd argue like tobacco, that the future is not great, or petrol cars, the future is not as great? If I was a DVD shop, then that industry is getting smaller and smaller, and the future profits aren't as big. So I have to make those kind of assumptions.
Well, you have to make a judgment on the management. And I think I can't emphasize how important it is to sort of make an assessment of the management of a company. And there are some managers, CEOs, finance directors, etc., who are absolutely fantastic at growing businesses. But actually, most of those are absolutely rubbish at cutting costs. If there's a recession coming, they don't know what to do. They'll end up losing lots of money. And they'll be behind the curve in trying to get the business into shape for a slower economy. But when things are going well, they'll outstrip the growth over there. Those growth managers are great. And if you want to buy a growth company like NVIDIA, you want to make sure there's someone at the helm who knows how to grow it. Now, I remember years ago, BP was built buying loads of other big oil businesses and then cutting the costs aggressively, taking out the head office, cutting loads of people, cutting back, selling off assets they didn't need. And BP became the biggest company in the FTSE 100. The management, he was considered the biggest and the best. But he scared his management team so much because if they didn't deliver on the cost cutting, they got sacked or he sold that business. And so that management team started lying to him and not giving him true numbers. And when you lie and you don't get true management information, no matter how good you are at the top, if you're getting false information coming through, you can't manage the business until it's too late, because eventually it comes out. It always does. It always will. And sure enough, it did. So enough of these managers, middle managers, had not been telling the truth. They suddenly started missing their numbers. They had to make a reassessment of the value of all these companies they'd taken over. Their share price plummeted, absolutely plummeted.
Now, talking about profits plummeting and worrying numbers, we have had our first question from a listener. A reminder,
We've got one.
if you want to ask these gents...
Thanks, Chris.
If you would like to send in a question or a story or ask the advice of these two gents, it is theartofinvesting@ig.com. And that's exactly what our good friend did. And the question is, gents, what has been your biggest loss? And how do you recover psychologically from that impact?
It's difficult to say what my biggest loss is because over the years that I've run money, there have been some very big losses. And before everybody thinks I'm completely useless, that's because I've run a lot of money. So if you run a lot of money, when you lose money, it's a lot of money. But the one I remember really clearly was in 2001, a long time ago. It was an issue called Railtrack.
Ooh.
So in those days, I mean, a long, long time ago, Railtrack was the precursor to Network Rail. It was running the rails and tracks, funnily enough, in the UK. And we held about 300 million corporate bonds in Railtrack. And one Sunday morning, I'm not feeling great this morning. I probably drunk a little bit too much the night before.
It's just any Sunday.
and my wife had gone out and got the newspapers. And so she threw the newspapers down on the bed, and front story on the Sunday Times was Railtrack to be nationalised, essentially, by Tony Blair's government. And I sort of looked at it and I thought, oh God, oh my God, this is going to be terrible. And we'd lost, I reckon we'd lost 50 to 60 million quid. And I'm sitting there thinking, oh my goodness.
50 to 60 million
50 to 60 million quid. What's 10 million between friends? It's somewhere in that range. And I'm thinking, this is going to be very, very, very difficult indeed. Now, as I've said to people before, an old saying from the banking crises, if you're going to go bust to a bank, go bust in a big way. Because if you go bust in a small way, the bank can handle it. If they go bust in a big way, it's somebody else's problem to handle the bank going bust.
And 60 million.
And 60 million's a pretty large amount. So what we needed to do was to therefore make clear it wasn't just our problem, it was the problem of the government. And I'm not going to go into the story because I know we're short of time. But we managed to, with other investors, go to see the government and get them to realise they were going to have their own taco moment. Treasury always chickens out. And they repaid us all the money of our bonds, so the loss suddenly disappeared.
Oh, I think we'll be coming back to this story in future weeks.
Much bigger story. But the question was, what did I learn from it? The first one is, and it's a crypto expression, DYOR, do your own research, right? We bought Railtrack bonds because it was government, we essentially thought it was government risk.
Yeah.
And they decided to foreclose on it. So do your own research, number one. Secondly, the second lesson, as I said before, is if you're going to have a problem, make it a big problem and make it somebody else's problem.
Sounds like make it the taxpayer's problem.
Yes, absolutely. It was. It was. Thank you, Tony Blair.
Right. On that, Spice.
Well, I did my own research. When I first started working with CJ back in 1990 with a company that I won't mention here, I just joined the company and I was an analyst, a fairly junior analyst. And my job was to go away, and it was a sector called Overseas Traders. And there was a company in there called Polypec. And Polypec was the Nvidia of its day, if you like. It doubled and trebled and was a FTSE 100 company. It was the darling company in the FTSE, and it could do no wrong. And it was run by a guy called Aslan Nadir. The name would be imprinted in my mind forever. Anyway, I went away and did my own research for the team. Mm-hmm. I went back, presented it to the team and said, yes, we own none of this share. We really should own some.
This was your baby.
And I said, I think we should buy this. So away we all trotted over the next few weeks, and we bought about £10 million worth of stock. And sure enough, I go and have my first holiday since I'd joined the company. And this is at the beginning of September in 1990. I pick up a paper on a Thursday afternoon, an English paper, and Polypec shares suspended. as all the dear, financial irregularities, investigation, all this. This company owned Del Monte, which you've all heard of, the orange companies and all the rest of it. And basically, he'd been doing dodgy stuff with the foreign exchange through Turkey. Irrelevant, because the shares never relisted. They went bust. So for all of our shareholders that in our funds, because they're shareholders as well, going back to the other thing, that price went from basically £6 a share to zero. And it stayed in the report and accounts as zero for several years until the tax man said, right, you can take it off now.
Right.
I mean, I then had to go to the main board of the company I was working for and explain why, having owned none of these shares, I'd said, go and buy them. Now, talk about being dropped in it by your senior management. Thank you very much.
Yeah.
And Chris wasn't one of those at the time, but he was a colleague. We were working very closely together at that time.
And I love that this is going back to 1990.
Oh, 1990.
So we got many more stories since then, but we're just giving you a tantalising start.
35 years more of stories. Unfortunately, we are coming to the end.
I've got it. You want the lesson from this, right? If in doubt, if you don't understand something, don't do it. If in doubt, do nout. Right? If it's too complicated to understand, it's probably a wrong end or not worth investing in, because there are plenty of things you can understand.
Yeah.
The one thing it made me was an absolutely ruthless cutter. If I get something wrong, I sell it straight away and I get rid of it. I'm a cutter. I get rid. And for me, I clear my mind. I can sleep well at night, and tomorrow is another day.
If the story changes and if there's a real negative story, such as the central bank independence being lost,
or management changes or something comes out, get rid of it. And then you sleep better, you come out with a clear head the next day, and off you go again.
Excellent. Right, well, that is us coming towards the end of today's podcast. It's been another fantastic week, very enjoyable. If anybody's listening, should they follow and subscribe?
I think so, definitely. Yes, without a shadow of doubt. We are trying to help people and educate them in their financial journey. And we'd love everybody to subscribe and support and follow this podcast.
So if you have enjoyed what you've heard today, then be sure, as the gent said, to like and subscribe, give us a follow, tell your family, your friends, and anybody you think that has maybe mentioned to you, I'd love to get into this investing thing, but I really don't feel like I know what I'm doing. Well, now there's a way to find out. Any stories that you have for us, your successes, your near misses, then be sure to write us in at the email address, theartofinvesting@ig.com. We look forward to seeing you next week, gents. I hope there's no big losses to come.
So do we.
So do we. Thanks, Rich.
Thanks, Rich.